Ladies and gentlemen, it has come that time once again in which we will have our strategy session. Now, some of you may be new to this concept, but what we do is we have a little powwow with our trading team. This is where we come together and discuss some key themes that we might be seeing in the markets, how we might be able to take advantage of them, maybe even what to avoid. So I'm going to welcome everybody in, and just so everyone knows, this is something that we used to do in the privacy of our own office, and then we would post notes and whatnot, but you actually get a backstage pass to what we do and how we're thinking. So I'm going to welcome everybody in, and I'm going to lead off with chart trader Brett Manning. How are you?
I'm doing good, Jim. How you doing?
I'm doing quite well. I always like to start with you because we take a top-down approach with you, and then we kind of work our way through the markets. But I want to start with how just remarkable this period has been in terms of how the market itself has handled these unpredictable new risk events. We had the Iran skirmish, we had the coronavirus, the impeachment trials. How does all this fit into your big picture roadmap from a top-down perspective?
So it fits in pretty perfectly. Last time we had our strategy meeting, I introduced what I was calling the contextual bullish perfect storm. So that's the type of environment, and it added to that contextual bullish perfect storm, which is made of three factors. I'll really briefly summarize. Added to that is a sentiment backdrop going back to late last year that has had a kind of pervasive resetting to pessimism around every corner. Every little thing that goes wrong, you start to get signs of people immediately rushing for a more pessimistic view, picking tops. And amazingly enough, we just saw that again with coronavirus. When you look at some of the survey data, particularly the American Association of Individual Investors shifted to way more bears than bulls. And that's a really odd state for it to be in a trend that looks like this. So there's continuing to be that kind of disproportionality to how quickly people get bearish on this market the second there's any kind of pullback. So even while we see some signals of exuberance, when you get that quick kind of recheck back into a pessimistic view in terms of a lot of different sentiment data points, it usually is a sign that you're not really fully matured into a kind of exuberance. So that's part of it, but the contextual bullish perfect storm that we talked about last time is really made of the fact that it was the first time ever that we've had the ECB, the BOJ, and the Fed all doing some form of balance sheet expansion at the same time. There's fiscal and monetary easing basically all around the world. A lot of big global macro risks got taken off the table. Brexit's basically in the rearview mirror. The U.S.-China trade war is at some version of some kind of stall point or whatever you want to call it. And you've got all-time lows in unemployment rates in basically everything in the developed Western world. So that, along with those signs of inflation, gives you a global macro policy risk backdrop that's really, really favorable. At the same time, we're heading into comps that are amazing, right? You're going to look at Q2, Q3 comps for a lot of different companies and for the global economy and the U.S. economy in particular that are going to be really easy comparisons on a year-over-year basis once we get to summer. So the market's trading in front of that. You're going to see a lot of growth. Even if it's not really that much growth, it's been this kind of flip-flop back and forth over the last few years, all originating from the sort of bubble and push that we got off of the tax reform bill in late 2017, which had its big window of impact in Q2 and Q3 of 2018. So that created terrible comps for 2019. We got the inverted yield curve. We had a ton of pessimism come in, a lot of recession forecasts last fall. Now we're moving into a period where we're going to be comparing on a year-over-year basis with that period. So it's going to be much lower bar for the market to jump over. We got that, and then we've got the Fed's, what I call the Fed's pledge, where the Fed reinforced again. Basically, they've pledged in between the lines. You have to know how to listen to the Fed, but they basically pledged that they're not going to hike, they're not going to tighten policy unless we see a manifest inflation problem. So in other words, every little good data point, you don't have to scramble for, the Fed's about to raise rates. They've decided to take a very proactive position where we're going to be really skeptical about the possibility of inflation until we see it. So that's the point we've gotten to, and the market knows that. It doesn't have to shy away from improving data. At the same time, we've had the new risks that you talked about. come into the picture, and the response has been, hey, we don't have to worry about actual performance because these risks are there. So you've got the context that's the most bullish it could be, and you don't have to worry about how things are performing in that context because there's plenty of excuses out there. And there's plenty of excuses for policymakers to stay just as easy. And now China is really on board with the stimulus. So we've got all of these kinds of responses. We've got this really strong context, and we've got a situation where the market knows that people are going to look off into the future toward those easy comps, and we don't really need to see performance right now. So the bar is low across the board. Everything is sort of set for things to move higher. I've recommended having just an unleveraged investment portfolio along the market and not really toying with it too much. I've divided my own capital. I've talked about this a few times. I've divided my own capital into a trading book and an investment book, and the investment book I virtually don't touch at this point. So you've got this sort of backdrop that makes it easy for us to handle new risk factors coming in, especially since we've seen a period where we've had a very low commitment to the stock market by retail investors who maybe now are just starting to get excited about the market again. And I would point to Tesla as an interesting example of something that's maybe the first time where we have seen something that looks like the sort of big cap market example of a market story that feels like the late 1990s kind of action. And that's important because it's not just about Tesla. It's about the idea that for people who weren't actively a part of markets and trading in the late 1990s, it's really tough to remember or understand what that was like. But to give you a bit of a slice of it, people didn't talk about percentage gains. They talk about X, as in 5X, 10X, 20X, 30X. Because that's what stocks were doing. You'd find something, if you could pick the right stock, you make 20 times your money. So that type of phenomenon has I think like a viral impact on retail investors who start to see, their next door neighbor maybe bought Tesla and made 5 times his money in a couple months. And that kind of thing becomes a narrative backdrop where I think it pulls people into the market because it's not just about investing wisely and making a 10% return over a year. It's about getting rich in a few months if you pick the right stock. And that kind of environment feeds on itself, I think. So we needed a stock like Tesla to come along and be that sort of symbol that can get people, Main Street investors, excited again. I don't think this has the potential to become like what we saw in the 1990s because the demographics aren't there. The target market for that kind of marketing from Wall Street is your 42 to 56-year-olds, and that's a really small demographic in our society today. So you've got a lot of older people, baby boomers. You've got a lot of people who are younger than that, millennials and the generation after them. You don't have a lot of people in that demographic swell, so it maybe can't get to anything like what we saw in the 1990s, but it's going to try. And I think Tesla isn't really necessarily a sign of the top. I think it might be a sign of the beginning of the process of that sort of narrative fuel coming in to help retail investors become more a part of this market, and the zero commissions cost actually helps that as well. So I think that makes it easy for the market to be resilient in the face of some of these risks that you're talking about.
So before we get too far into the woods, I want to ask you, is there anything that central banks can't fix? Gavin and I were having a discussion earlier today about the coronavirus, and China came out today and said we're going to do everything we can to contain that. But in the meantime, we're going to increase stimulus. And that seems to be the go-to, and it has been for a long time, that anytime there's a problem, market drops a little bit, central banks come out. So now I guess anything, even something biological, the central banks can fix.
Sure.
I mean, so what
the scientists at the Federal Reserve are hard at work.
Okay, so what I'm asking is, what is the real risk? How far can this thing go to where there is true risk and there's something that can systematically just break down the system?
So when we get to the point where we disprove the efficacy of central bank action, I think that's a big structural theme that we're somewhere in the process of Eventually, we're going to prove that. Eventually, we're going to prove that to the market's detriment, where there's an impotency, and there really is a faith-based kind of issue there. But I don't think that this is just about the central banks. I think that where the market is, and I wrote about this in my notes this morning. I think the market is assessing what the true scope in the worst-case scenario of the coronavirus situation is, and if it's not really something that health authorities think they can solve by limiting travel, which has started to become the tagline, not in China, but outside of China. There's no reason to, really impact economic activity because we can't control this really anyways. And so, where's it going to go? It's going to run its course, and we're not really going to be able to contain it. We're going to have to come up with a vaccine, and we're going to have to come up with ways to care for people. The mortality rate is very low, so it's sort of like a really bad cold, and it may be something that we can't really contain. But I think that markets are willing to say, well, this is going to get more stimulus in the system, and they never take it back because there's not going to be an inflation problem. So whatever else we bring in is just going to be there now for when we're past the immediate expansion of the threat around coronavirus. We're going to pull in a new mechanism, extra stimulus, that's just going to be hanging around. And they're not going to take it away because that would be a negative catalyst. And without inflation, there's no reason to have that negative catalyst. And at the same time, the nesting that's going on associated with the coronavirus is really just pent-up demand. As soon as people start to feel like they're past the threat of this expanding into their household, you're going to have, probably the biggest week of economic activity in Chinese history. The next thing that's going to happen around this corner as people start to venture back out in the most affected areas is going to be a massive display of pent-up demand. And the stimulus is not going away then. So the market is probably front-running or discounting that kind of dynamic.
One more thing I want to ask you from a macro perspective is what is the actual risk that due to the coronavirus that China may try to play some games and say, hey, we might not be able to keep our commitments. And if something like that happens, then, okay, so handicap that for me. Give me the probability, and then what would happen if indeed they say we can't honor these commitments for whatever reason.
You mean the phase one trade agreement?
The phase one trade, correct.
I think the market knows that was a vacuous agreement in the first place, so I don't see that as a big risk.
Okay. All right. Well, fair enough.
It was a public relations agreement. It wasn't actually a substantive improvement in terms of trade.
But we went up on that, so I would assume that there would be some negative ramifications if there was even some rumors or some hints that, hey, we're not going to back out of this. I don't think that would sit well with Trump.
But would he, at this point in an election year, want to bring that tumult back onto the table? Or would he rather see the stock market keep flying and the economy keep improving? I think that's the difference. I think that they can message around that in a way that is somehow fitting with the narrative where he doesn't lose steam in terms of his China hawk base. I think there's a way for them to handle that has more to do with their PR department than it has to do with reviving growth in tariffs.
All right. So in a nutshell, the market's not going down until after the election.
I'm not going to go on the record saying that that's definitely the case, but I think that the backdrop supports a view where this is less vulnerable than it may appear.
All right. I do want to ask one more thing regarding your trading activity. We did see a little uptick in the VIX. We were trading, I think, above 18 for a little bit. We're now back 16-ish. And I've noticed that your trading activity hasn't really gone up. It hasn't correlated with that uptick in the VIX.
Right.
Is it because
typically
of lack of opportunity?
Typically it does in a pop in the VIX.
Right, yeah. Right.
So I would say so one thing is I have a general rule where, from November to late January was a terrific period for me. And I had a little bit of a sense of, I know that studying my own past history, the early half of earnings season is not a particularly strong period for me. It's just not. It's the market becomes much more about a collection of individual equities and money flows. I think the money that's dominating what the market is doing is a different kind of money that's around for the rest of the time. Really, the first 2-3 weeks of earnings season is a separate sort of special period where the market is dominated by money flows that have to do with longer term positions managed by long only, equity only funds. We know with tens of millions of shares in some of these companies, and they're repositioning around them, and they have a low turnover rate except for during that period. So the volume in the market becomes dominated from a very bottom-up perspective. I tend to do better when the volume in the market is dominated from a top-down perspective, which is most of the rest of the time, I think, at this point, given some of the index instruments we have. So I tend to pull back on the throttle then anyways, but I would say that this was an example, and there are two types of elevated VIX. I think when you get wide swinging, loose price action that is not necessarily related to a headline that just happened a couple minutes ago, that's a great environment for me. But we didn't really see that. We saw the VIX move up, which really implies, essentially the pricing of options around, what volatility is going to be. We saw people price options that way, but it wasn't really, I would say, loose, wide-swinging price action independent of headlines. We never really got to that point. We got Friday last week, it was basically every tick was a down tick from opening bell to closing bell. Then this week, it's basically been the opposite. There hasn't been a lot of swinging price action. There hasn't been a lot of loose movement. There hasn't been a lot of serial correlation inside of pattern structures where people are put in a position where they're in sort of a game theory conundrum, given their money and given what choices they've recently made, and they have to account for that, and the pattern comes to dominate, herd people together and force certain outcomes. And that's the type of thing that I tend to be able to read very well. I saw the VIX. I wanted to trade more, but I just had to say to myself, I'm not going to go ahead and put risk in play unnecessarily when I don't feel like I can easily sync up with what I'm seeing. And I would suggest that people take that as, I've been doing this a long time. I found that I can make a lot of money by isolating my risk. Think of risk as an asset. Spend it when you can have conviction based on your prior experience, based on what you understand of when you have an edge. Don't spend it when you get the sense that you don't have that edge. And I think that selectivity is one of the most important points that you can embrace in your trading. It really is. You can make a lot of money during certain periods and then give it all back. And a lot of traders go through that experience. If you get good at saying, this is when I should be lighter with my size, this is when I should have less conviction and be more selective with my trading, those periods would have been the periods where you would have given everything back that you just made over the previous 3 months. If you can learn to pinpoint those periods, even when the VIX is up, that doesn't necessarily mean it's on, I'm going to start banging 10 trades out a day. It wasn't there. I basically saw the situation, I saw the pattern structure, I saw the way the market was acting. It seemed extremely hinged on headlines, and we didn't see a lot of pattern follow-through at key moments when I wanted to see it, so I pulled back on the throttle.
All right. Is there any particular direction or something that you would want to see that would trigger an entry, maybe a headline-driven pullback that you would be able to buy the dip, something along those lines?
So I wanted this under 3,200 in the S&P on the long side, and I didn't get it. And with Friday's action and where the Shanghai opened on Sunday, I came into the day on Monday looking for an initial pop to the upside and then a follow-through move to the downside, because I really felt that there was going to be this rehedging process, and we didn't really get the rehedging process. We just basically, turned and went straight to the upside. So that was exactly the type of opportunity I was looking at, and I just had the wrong level.
All right. Gavin, I want to bring you in, and this is Event Trader for those listening. Event Trader, I want to bring you in and ask you the similar question that I had regarding the potential risk of the trade deal. Do you agree with Brett's sentiments on that?
I agree overall with the idea that the Trump administration would look to avoid having that unsettled markets, but I do think that there's some risk there given how much of a run-up we've had in the markets. We're kind of talking about the overall markets in general, and from my perspective, I think a lot of more of this has to do with liquidity than the economy. Brett and I would probably disagree on it to a certain degree. We talk a lot about this on our Flow show, and for the most part, I think that we're on the same page, but there seems to be a little bit of a disconnect for me between the markets and the economic data. Now, I do think that some of the PMI numbers that came out were suggesting that the economic data was starting to trend in the right direction, but now we kind of have to factor in this whole Q1 coronavirus, and it's just going to be interesting to see how people react to the economic data out of this, because I think a lot of stuff's going to be discounted. For instance, I think the next round of PMI and ISM numbers, they're going to kind of get thrown out because it's going to be looked at it as a one-time effect. Q1 earnings might even kind of be discounted at this point. So it's going to be interesting to see how the markets react to this, and it would certainly suggest it would be in the favor of the bulls. But I do think that the one interesting aspect of this is, again, going back to that trade deal, where there was a 90-day review period, and I'm just kind of curious to see what happens when I think it's going to be inevitable that China's going to fall short on their commitments to that trade deal. And I'm going to be real curious when it starts hitting the news wires, and we know the news wires are going to be jumping all over this. How is the Trump administration going to react? Is it going to be more? We've seen in the past with markets at all-time highs that he feels like he's got a little cachet in his pocket and is willing to be a little bit more aggressive on certain fronts. So I don't think that he'll just let news stories about him looking weak on China go without some sort of commentary or some sort of tweet. Now, that being said, I think what it would do more than anything is just kind of knock out some of the highly leveraged players in here and open it up for buying opportunity. But so far market participants have shown that they're just willing to buy any dip, no matter how small, and kind of jump in. So it's tough to figure out exactly how much of a disruption this could be. And then, just going back again to the liquidity aspect of the markets too, that's another threat that I would say that we have to be on the lookout for, meaning if we start seeing the markets really get crazy, if we see a couple of Tesla moves like we're talking about, at what point does Powell and companies say we're starting to see a little bit of irrational exuberance out there in the markets? And I think that's probably an even bigger threat to where we are currently, especially if you're of the opinion that a lot of this buying in is some leveraged up liquidity that's being juiced by the central banks. So, I definitely agree with Brett. I wouldn't be going in bearish at all. I'm holding on to my positions. I haven't been covering too much at all anything. I do think that this could set up for some nice volatility on some pullbacks, so it should hopefully be a pretty good time to be trading in the markets over the next couple of months. But I'm not looking for an unabashed parabolic move to the upside. And then the other thing that I would just note too is we were talking about those Iowa caucuses, and right now the Democratic Party is just not in a strong position to unseat President Trump, and I think that the markets are kind of coming to that theory. Even the idea of Bernie getting in there, which one would think would cause a lot of selling, people are starting to get the idea that he would not be able to beat President Trump given the current economic conditions. So, for me, monetary policy is turning into a key read for what the market's going to do, given how I feel that liquidity has really been an extra juice to markets here.
Brett, did you want to jump in real quick?
No, I just want to say I actually agree with that perspective. I don't think that Gavin and I are disagreeing on anything. I see a disconnect as well. I just think that that's why I call it the contextual bullish perfect storm. It's not about the performance. The performance hasn't been there. It's just the context. The playing field is laid out to foster the best possible interpretation of whatever performance we see, because people are consistently looking ahead to an environment where the Fed isn't going to take anything back. Nobody's going to take anything back off the table, and the comps are really easy. So I think that the performance coming through, actually seeing the economy start to produce better, to perform better, is something that hasn't been a part of the puzzle yet, but people are willing to give it the benefit of the doubt that will happen. But I would agree with him based on everything that he said.
Yeah, I would think that the bottom line for both Brett and I's thoughts is that you're staying long in your longer-term holdings here. There's not a reason to jump out, and there will be some volatility opening up for a little bit more riskier trading, some more speculative positions, you probably want to keep the size there a little smaller, but you know, you got to keep riding this wave for now, and just be prepared for those dips to either getting a few short opportunities there, or you know, keep a running collection of names that you would want to buy on pullbacks. And I think that's kind of how I'd be attacking it, Brett. I'm assuming that's kind of your thought process here too.
Certainly.
All right, Gavin, are there any other key themes that you want to highlight so that we can pay attention to? I know you were involved in India. You got out of that one. Any interest in getting back in?
In India?
Correct.
In the INDA?
Correct.
I'm still over in there. So
oh, okay. I thought you were out of that one. I'm sorry.
No, I was keeping an eye on it. Basically, you know, the thing that I was talking about was that it had so much negative news, but it just kept going sideways. And that's kind of what's been keeping me around. Now, there's certainly some caution there, you know, especially if we start getting headlines about the coronavirus spreading into there or something like that. But, you know, it's one that I'm just kind of keeping an eye out on here. Same thing with South Korea and stuff. You know, I feel like that they will be good positions. It's just a little bit of being rattled around. It could be a volatile Q1 for them, because basically what we're looking at is a lot of economic data that's going to be tough to interpret because of the shutdowns that we're seeing. And again, that's why I think a lot of people will be willing to give the econ data over the next 6 to 7 weeks a little bit of a pass. Also, you know, Q1 earnings, it's just going to be anybody that misses. Even people that haven't even seen the coronavirus are going to say the coronavirus was the reason. So you got a built-in excuse. It's going to be a little tougher to figure out. But, you know, just keep it in there for now, and just going to be watching how things unfold over there, what kind of disruptions we get, and more importantly, how the markets react to some of the econ data when it starts reflecting the impact.
All right, we're going to bring in blue chip trader now, Scott, and I want to get your perspective over what you're seeing in some of these sectors. One of the sectors that you had highlighted last time was energy, and it's been a little bit since we had an update there, at least on this format. Have we seen maybe a turnaround beginning in energy? I know it looked like it almost put in somewhat of a capitulation type low yesterday. We had a rebound today. So just want to get your overall thoughts. We'll start with energy and work our way out.
Yeah, real simple. Avoid energy at all costs.
Okay.
Don't even go near it. No, it's been the worst performing sector for almost 2 years now. It's been technically just absolutely horrible, trending below 200-day moving averages, 50-day moving averages, long-term downtrends. It's completely under-owned, under-loved, and you're just starting to see some massive breakdowns in a lot of these charts, including ExxonMobil, Chevron, all these disappointing earnings results. If you're getting involved in energy, you better have a short-term contrarian view and approach to manage that risk in order to do so. And that's the end of that story. There's no institutional money scooping this thing up whatsoever at this point in time. And if you are trying to play a bounce in it, that's all you're trying to do is play a bounce in it. So, you know, treat it as such. So that's it. I would just, otherwise the opportunity is just continue to just lean on this thing on the short side.
All right, so no rotation into energy as far as you're seeing.
Not yet. I mean, unless this was the final, you know, capitulation to the downside, that could potentially be the move there, which is why I just slowly initiated a small 1/3 size in the ETF ERX yesterday off that $12 area. But again, it's literally 1/3 size, and I'm just basically trying to play that contrarian bounce after a really awful start to this year. And if I can catch, you know, 5 to 10% bounce, I'll take it for a swing trade. But bigger picture, you know, looking out how this is going to play out, you need a lot more time to fix the damage that's been done on these charts on a technical basis.
One of the things that I've noticed with your trading this quarter, Scott, is you haven't had a whole lot of disruptive gap trades due to earnings. And I guess that's kind of a good thing for earnings in general, because if we're not having disruptive gaps and things are kind of moving smoothly as expected, so it's not all that good from a volatility standpoint, but it is something that I've noticed. Are you noticing the same type of thing, that trade is not necessarily all that relevant in this particular time period?
Yeah, not yet. I mean, we're still pretty much in the thick of earnings season here, so but I would agree with that. We're not getting as many of those disruptive gaps, which are usually defined as up or down 10% from where it's been trading the last couple of weeks or so. Just hasn't really been the whole on board. It seems like everything's been somewhat in line or somewhat expected, or the market people just seem to be very slow to respond to sell to any sort of earnings report that comes out, or even squeeze things higher for that matter. So it seems to be very non-disruptive, kind of just keeping status quo and whatnot. There've been a few here and there, like Triple M gap down over a week again, and that to me was disruptive, so we got short some of that, and that's been paying off for us really nice. But otherwise, yeah, I would agree with that statement.
All right. Any other key themes that you want to highlight? Any other sectors that are really catching your attention?
Well, overall, I love to watch the cumulative AD line on the exchanges, and I look at that at a big picture view, and we've been in this pretty strong bullish uptrend since early 2019. If you recall, late 2018, we had a pretty sharp correction in the major indices, about 20% or so, and then the market just kind of took off throughout 2019 for one of its strongest gains ever. And then here we are, back at that same state, up at all-time highs for the indices. And I've said this before, the market takes time to top out, if it's even topping out. And at the very least, you have to remember that sector rotation is one of the key things that usually keeps a secular bull market alive. And this secular bull is about 10 years old, and it's just this constant rotation between sectors. And as long as you can continue to identify relative strength and in those different industries, you can really take advantage of it. Now, bigger picture-wise, like I said, if you avoid energy and you bought pretty much anything else, you should be making money here. And I don't care if it's more defensive, because utilities have been strong, REITs have been strong, staples have been strong, gold has been strong, bonds have been strong, and then you can throw in technology, housing, clean energy. Software's on fire today. You got software stocks just breaking out again. These exchange-related stocks have been acting strong. I mean, this market, and I'm not the biggest economist in the world, but I've said that this feels like a Goldilocks type of market to me, where everything is just textbook perfect to continue higher, and it's just going to be a matter of what is going to come along and knock it off its course. And so right now we have this coronavirus, but that's like a huge systematic risk that's out there that you can't really foresee, or you make your necessary adjustments, and then hopefully it gets contained enough that it would set the market back on its course to the upside there. But until there's some massive economic fundamental shift in the market that starts to have people, and I should say funds, institutional money, really start selling and really being concerned, then you just got to ride the course out here. And I'm looking at names. You look at the liquid momentum focus list. I mean, Microsoft is up $5 today, all-time new highs. It just got so many of these leading stocks that just continue to break out to the upside. Amazon, which has been a laggard for the last 6-7 months, they had a fantastic response to earnings, gapping back up over 2,000. I'm not even going to touch Tesla. It's in its own little stratosphere of its own. But there's just this mentality out there that stay with the status quo, and the status quo says to stay long right now. The trends are really strong, and no matter what the market's throwing at this, it seems to continuously be climbing this wall of worry that's out there. Mostly, I think, due because of what Brett and Gavin just highlighted. The sentiment is that this market, it seems like it wants it. There's so many people out there that want this market to go down so much, and as soon as they get that one, worrisome headline out there that takes the market down for more than a day, it's like that's it. The world's come to an end and everyone in the world wants to be short again. And that sentiment shift is so strong these days, and we've seen this repeatedly over the last year or two, that's not how tops form. That's not how the market historically has topped out. The market tops out on euphoric environment, and when everyone's talking about the market. When your mailman is telling you that he just made, X amount of money on some hot stock tip, and when people outside the industry start talking about the market, then you should be concerned about how high the market's going to go. I don't think we're at that phase yet.
Well, I can't wait to ask my mailman what he did in Tesla. Then I'll know. I'll tell everyone when my mailman says he made money in Tesla, and I'll let everyone know. That'll be the trigger. All right.
But I do want to say one thing, though. Brett made a great analogy. If anyone did not live through or trade through the late 90s with the internet bubble, Tesla is a perfect example of what majority of stocks looked like during that time frame. It was pretty insane. Stocks were just ripping higher and gapping higher significantly, and there was just no end in sight for these names. So that this chart is definitely reminiscent of a late 90s internet type of move, in case you're curious to know how it felt.
All right, well, that gives me an opportunity to bring in Trend Tracker. Now, Craig, you've been a bull of Tesla ever since I've known you. Are you still involved in this name?
No, unfortunately, I've been out for a long time. Yeah. I was like an initial bull when they first launched the Model S. So I was in like around 30, but I've been out for the last 600 points or so.
Well, I'll tell you what, you actually do a good job of snuffing out stocks that end up looking like this. TTD, no exception. But why don't we talk about AIMT, because a lot of people have been asking about that one, and you did profile how you would enter this trade as a day trade, hybrid, swing trade. You laid that out yesterday, and you got the moves you were looking for. This thing dipped down to that $30 level, and you added to it. Actually, you just added to it while we were talking at around 29.65 or so. So why don't you talk to us about this AIMT, what you like about it, why you still holding it, why you still trading it?
Yeah. So obviously we've seen a pretty significant sell the news reaction here, and I had kind of forewarned about that. I said I wouldn't be surprised to see a sell the news reaction. I probably should have sold more back in the mid 30s. I did take profits around 35 or so recently ahead of the approval, because I said it was mostly priced in. It was probably mostly priced in. I did think there was a chance that we could see some kind of euphoric surge this week on the news, but the sell the news reaction was more likely. At this point, I think I find this stock attractive again from a long-term perspective. This price action right now is not encouraging. I almost bought it at 32 yesterday, and I said I liked it under 34. I am surprised that it's fallen below 30. There's a chance that. It essentially has become now a show me story. So they're going to have to commercialize. They're going to have to prove the therapy has a market and do well. So this stock could just consolidate over the intermediate term. Obviously, this is a pretty sharp reaction to the downside. So I would like to see some sort of sharp bounce, but as the price action has dictated the last 2 days, it doesn't necessarily look like one is coming here right around the corner, but we'll see.
All right. Were there any plans on adding additional?
So I already have this as a large investment, and now I've kind of added a full-size trading position here. I'm going to let this one play out for now, and I'll see. I mean, as of right now, the price action isn't super encouraging, so I'm going to sit on this for now, but we'll see what happens.
All right. Well, you do have your stop on your day trade, so at least you have your risk in check, and you're not using any type of stop on your investment holding.
Correct.
Okay. Well, TTD, there's a big one breaking out today. All-time highs in TTD. You're still long this one. What's your strategy as far as how you're going to treat TTD, the trade desk?
Well, my strategy is to own this one. I've been in this one from about 50, and the expectations are high right now, and the valuation is quite rich. But I think it's that way for a reason. They are, if I can put it in the most simple terms possible, it's an advertising company that is effectively disrupting the Facebook Google duopoly, and that's just more with large advertisers, big brands. Facebook is always going to dominate with small businesses, and Google is obviously, with their search business, is the backbone of the internet. They also have YouTube. I'm not in any way really saying that they're going to disrupt Facebook and Google or really impair Facebook and Google necessarily, but this is the play on basically picking up share and making the duopoly less dominant, I guess I could say, over time. The TTD basically provides a solution for ad targeting across the rest of the internet, and most companies don't want to share their data with an Amazon, who is actually the number 3 player now. So the trade desk allows ad targeting like you can on Facebook across the rest of the internet. The other big bullish thesis behind TTD is the fact that it's one of the best ways to play the shift to TV streaming. Pretty much anything that has ads on it, unlike Netflix or Disney Plus, that is in the TV streaming ecosystem, you can buy ads through the trade desk to target people streaming video. And again, this is outside of a YouTube that actually has ads, or outside of Netflix or Disney Plus that doesn't have ads. And that shift to streaming TV is really accelerating this year, but it's a long-term thing that's still relatively early. So that's why I liked TTD, and that's why I liked Talaria, who's now merging with Rubicon, because they were, in my view, the best ways to play that shift to streaming TV. So, we have all these media companies like Viacom, CBS, that are trading at dirt cheap valuations, sort of like energy companies that are just totally out of favor because the longer term trends are going against them. So you want to be long the winners that are in best position to take advantage of those long-term shifts. So, Tesla's another one in terms of clean energy, electric vehicles, and then you have, in terms of the media, the shifting media landscape, you have something like the Trade Desk or Roku. Talaria is another one that I'm long. All these tech stocks are kind of on fire today. Obviously, things were being held back last week by fears over the coronavirus, and now that seems to have dissipated. So it's just, we're kind of back off to the races today, it seems.
All right. Well, I hope TTD gives you another 600 points on this one. It goes exponential like Tesla does. So you can only hope, right?
Yeah. Well, and that's a good point. So the sales and earnings multiple don't necessarily look attractive, but it's expensive for a reason. The market cap is still only about 13 billion. So long, and they're going after the same digital advertising market as Facebook, Google, or pretty much any other advertising company. Now, unlike a Pinterest or a Snapchat or a Twitter, it's not just one little property that they are serving ads on. It's essentially the rest of the open internet, which is how Jeff Green likes to put it. So long term, I still do see a lot of potential upside because the market cap is still relatively small. You got Google, which is over $1 trillion now, I think, still, and Facebook is what, 500-600 billion. So they are well positioned to continue capturing market share in the ad market over the long term. So that's why it's my largest position, and I'm going to continue to hold it, buying significant pullbacks and maybe trimming into significant strength. Obviously, I don't necessarily want to sell into this breakout today. We have earnings coming up in a couple weeks. I think it's towards the end of February for the trade desk. And expectations are going to be high because, if I've mentioned this a number of times now. They didn't really blow out the third quarter number, so it initially kind of sold off. But all of the details around the report were extremely strong. Basically, the company has been adding partners in the connected TV space, and they did throughout the third quarter. And those partners are Amazon and Disney, which obviously very high quality inventory partners, so it's basically being able to target consumers streaming on those services, so that he basically said that growth accelerated in September, the last month of the quarter. So expectations are high not only for this quarter but all of 2020, because the whole cord cutting trend has accelerated. Streaming TV really became a big thing last year, as we saw in TTD and Roku's performance, but it's a long-term thing that has legs. So this is one of the, obviously Disney Plus just launched, and it's a big deal. And again, it's probably the best stock to own to take advantage of the shift in streaming.
All right, and I want to touch on this new IPO that I think is to launch on Thursday, SDGR. I bet you a lot of us don't know about it. I don't know about this company, but you seem to like it. What is it that is so compelling about SDGR? Talk about this one.
Yeah, so Schrodinger is coming out on Thursday, I believe, and it's a really interesting, really attractive, pretty compelling business in my view. So basically what they do is they sell software to all the big pharma companies. The top 20 pharmas are all a customer. And it's essentially software that helps with drug development. It's a leader in physics-based computational drug discovery. So basically, pharmaceuticals can use this software to kind of test on a molecular level how drugs, if they will work, and how the molecules will interact with each other. So they have like a pretty small software business that that services all the big pharmas, in addition to academic and smaller academic institutions and biotech firms. So now they also partner and work with biotech firms in drug development, and they also have started their own internal pipeline of drug development using their software. So there's really kind of three different businesses that are quite synergistic. It's effectively kind of like a biotech consultant / incubator. It's got the backing of Bill Gates and D.E. Shaw from early private rounds. I'm hoping that the stock won't get a lot of hype. I don't really want to chase it if it gaps up a ton. I think the expected price range is 14 to 16 right now. So I'm kind of assuming it'll come in at the high end, which will value it a little under $1 billion. If you back out the cash, maybe a little less than that. But under $20, I think this is a good investment, and it's just a matter of time before some more speculative money kind of comes in. I think around $1 billion, or about $20 or in the high teens where it's expected to price. It's maybe about 10 times sales, so it's not cheap. And there's a lot of people that are just going to look at this and say, oh, this is expensive. But, they basically use machine learning and data and modeling to try and help biopharma companies accelerate or reduce the time and money it takes to try and just develop new drugs. So I think it's a really attractive business. I'm hoping it doesn't really gap up a lot. I'm hoping it is a little bit more under the radar, in which case I think it could provide a really solid opportunity if you're patient with it and are willing to own it for a little while.
All right, good stuff. We'll have to check back in on Thursday to see if you do anything in that name. So, last but not least, we're going to bring in Scalp Trader Damon. How are you?
Hey Jim, I'm doing well. How about yourself?
I'm doing all right. So you weren't afraid of shorting Tesla today. I know it had to be a little bit nerve-wracking watching it go up, and I know you got stopped out, but you weren't afraid to step right back in, and it did move lower. So I think this gives you a really good example of how Scalp Trader approaches his day from a day trading perspective. He likes to look at stocks that move, have some sense of volatility, and he assesses his risk accordingly. So Damon, what was it that you liked about this one in particular? It was good timing because Citron came out with their short tweet about Tesla, so that worked out in your favor. But what was it prior to that you liked about it?
Well, the price action just felt climatic, and there was gapping up this morning on some analyst saying that he hasn't sold a share. Maybe he's an analyst or a fund manager. I never heard of the guy, but stock was up another 12% or so pre-market after running 20% yesterday. I just thought you might have had some retail money jumping in this morning at the open, and the reason, obviously a stock like this, low float, everyone's short. You don't want to get run over by it, but one of the things I'll try to do with short sometimes is try to catch that gap up reversal, whether it be on earnings or some type of news event such as an analyst upgrade. And so the idea was that hopefully I could pick it off near the top and catch a ride all the way back into the red. And so I was looking for pretty aggressive move back lower, but it just kept going. Got stopped out for about, I think, 3.5% on my first trade from the average entry. Second trade has been working out better. I think I trimmed some maybe at around 2% profit, and also maybe around 5 or 6% profit. Still have about a third on, and just checking to see kind of where that ends up. Hopefully we get a big sell-off at the end of the day that takes this thing back towards the 800 level.
All right, so that gives you a good little glimpse into what he's looking at from a day trading perspective. But since this is a strategy meeting, there are some opportunities that you're seeing in the distressed area. Why don't you talk about that a little bit and give us some color on what you're seeing out there?
Well, anyone who follows me knows that I'm a big fan of distressed. It's one of those areas that you have to do a lot of research, and that's where I try to add value. Spend a lot of time looking through these names, and I think right now retail and energy are fall into the distress category for me. And part of that is money just flowing away from the value space, as well as just terrible results. It was a horrible holiday season for retailers this year, and energy has been in a tailspin as natural gas prices have fallen below $2, and crude oil prices have pulled back to the $50 area. So everything looks horrible for both groups, which will create opportunity. These names tend to sell off together, get hit hard together, and my job is to go through and pick up the most compelling names that have been tossed overboard. And that's a process So with energy in particular, I'll be going through a lot of the earnings conference calls to see just what the outlook is short term. I'm thinking that the numbers are going to be bad. Stocks that are already at 52-week lows will go even lower. And we can start looking for some names that might make sense over the long term. So names that may have the cash flow, the strong balance sheets that will allow them to stay in business, but are essentially being sold at liquidation prices. So something that may have over time 4 or 5 times upside once the cycle reverses itself.
All right, but any names in particular that are on your radar?
Yeah, I don't want to put anything out there quite yet, just because there's still a lot of work to be done. So this isn't a buy today, sell next week. This is scale in over a period of months and quarters, and again, we're looking for big gains. So what I tell you today could change tomorrow, could change next week. It really requires me to go through, listen to the conference calls, dig into the names, follow the names for several quarters, and I do have some names on the radar, but they're not ready for prime time yet.
Okay. Was there one that you just got into? Ascena, maybe? ASNA? Was that a new one?
Yes, Ascena is a new one. That's a distressed retailer that's trading at essentially bankruptcy levels. So they owned, what is it? I think what brands do they own? Several large brands. I think
they own Justice, because my daughter makes me go there all the time.
Oh, really?
Yeah.
So that's one of the names. The Loft is one of their big ones. They own several other big brands. I don't follow women's retail that closely, other than from looking at distressed opportunities. So the names of the stores don't roll off my tongue, but some pretty large established names in women's retail. Stocks trading at about a $40 to $45 billion market cap right now. About 1.2 to 1.3 billion in debt, 600 to 650 million in liquidity. They've been buying back bonds in the open market at a discounted rate. They've been closing underperforming stores. So it's a name that, if they can figure it out and turn the ship around, I think this could trade easily 4 to 6 times above its current price. So I highlighted that one, I think, last week, and it hasn't been doing anything. But as I noted, I mean, this is a situation where it's either going to be boom or bust. Like, this is either going to be, I think, a huge winner, or it's going to go bankrupt. Unfortunately, I feel like we're getting it close to almost liquidation prices right now. So even if they did announce a bankruptcy, I think there's a limited downside to it because it's already trading at distress levels. However, it's something that you really have to take into account, that this is a very high risk, high reward type of scenario.
Okay, and this one trading close to its lows for spot 46. Ascena, A-S-N-A is the name we were talking about there. All right, I think that pretty much sums up what you have on the docket, right, Scalp Trader?
Yeah, so I just wanted to highlight some of the individual names that I'm looking at right now. I put on a long an IBM, I think yesterday I think it was, and this is a name that I've never owned before, but they announced a new CEO who's basically the head of their cloud strategy, trades at a 4.5% dividend yield. And I just really think that institutional investors will show interest in this name based on the success we've had with Microsoft after they announced kind of a similar transition, putting someone with kind of a cloud focus into the CEO seat. And IBM, after basically going nowhere for several years under past leadership, has shaken things up a little bit. I think IBM could be an interesting name here. And again, you get to clip 4.5% dividend in the meantime. So I think that will also attract investors. Just the idea of being able to sit on this and pick up 4.5%. Another name that I'm bullish on, I've been talking about, is YY, which is big in social media in China and India, both short form video, social media, and gaming. Stocks really cheap in my opinion. This is a name that I like for the long term. And, again, this was getting hit initially with all the Chinese names basically shutting down business operations, basically everyone being sent home and businesses being shut down for an extended period. But a company like YY should actually benefit from this trend as people stay home and get on the internet. But they also have major exposure in India, so they're not completely China exposed. So I think it gives you a little, exposure to other parts of the world, and their apps are really doing well. Their download numbers are really compelling. Stock is very attractive in my opinion. For a short-term swing, I like this ITCI. I own it from a little bit higher prices, but I think it's starting to base in here. You could have short-term 2 to 4 week bounce of 10 to 20%. So I guess that's all I have for right now.
All right, and I know IBM is a name that Event Trader likes as well. Do you want to comment on that one, Gavin, to close things out?
Yeah, just, David and I are both taking a look at this one. So the one thing that I'd note, Jim, if you could pull up that weekly chart, and you can see that we're coming up to that 200 weekly moving average right around this 150 area, which I think it's going to grind through here. It's got a little bit of momentum, obviously, built up, some pent-up demand for stocks there. And if you're looking at the valuation for this one, it's just really attractive here, trading at about about 11 times forward PE. Price to sales around 1.6 times. And again, that dividend yield that Damon mentioned. So, with that transition at the top there on the CEO, it's got to look similar to what we saw from Broadcom when Broadcom purchased CA, which led to a nice margin expansion from them. It's a story that we haven't really seen from IBM in a few years now. So I just think it's really lining up when you look at it on a technical and fundamental basis, and with a little bit of momentum here to be one of the top plays in 2020, especially when you looking around and people are looking for something with value there. IBM's one of the few names with momentum, value, and a good story behind it.
All right. Well, gentlemen, if there is nothing else, then we can wrap this one up. I'll let you have it one more chance if anyone wants to jump in. So I'll take that as a no. So we will indeed wrap this session up. And I do want to invite any of the listeners, if you have any additional questions or any follow-ups that you would like, hit us up on the Talk to Us button and address it to whichever trader specifically you would like have answer. And they're always good about responding back. It's always best, though, if you leave your email address, then we can direct the question, get it right back to you. Otherwise, it does sometimes get lost in the ether. So I want to thank each and every one of you for joining us today. Thank you for your input, and we'll look forward to doing this again next month.